Welcome back, dear learners. Before the ad break, we did some interesting adjustments that had to do with our tangible assets. We calculated depreciation and we also corrected an error. Now with us here, we have another interesting adjustment. Number 3, and it reads, provide for outstanding interest on investment. The first question that comes to is, how do we know that there is interest which is outstanding? The word outstanding is the same as owing. So there is some interest on investment which we have not yet received. How do we know that we have not yet received that interest on investment? If you come to your nominal account section, you have interest on investment, 5,400. The question is this all that we are supposed to receive? Is this all the interest that was due to us? If we come to the balance sheet account section, you'll find we have fixed deposit from Trust Bank at 10%, which is 180,000. So it means if I take that investment of 180,000, that is the investment. And on this investment, I must get a return on it, which is the interest on investment. I must get the interest on investment, and the rate is at 10%. So I'll come and say multiply by 10 over 100. And the investment was there for the entire year. Multiply by 12 over 12. How much is the interest that I'm supposed to get for the financial year? You get 18,000. So if I am supposed to get 18,000, yet I have only got 5,400, that therefore means there is some interest that is still outstanding that we have not yet received. Let me say it again, okay? Are you listening? We are supposed to receive interest of 18,000. That is what we are supposed to receive. However, we have only received 5,400. Therefore, there is an amount that is still outstanding. The amount that is outstanding, therefore, how do I get it? I'll then say the amount that we have received, which is 18,000, minus what we have already received, will now give us 12,600. This is what is owing or outstanding. This is the amount that we are supposed to receive still accrued. Then, when we come here now, we'll now say our interest income from the list of balances, 5,400. The interest that we're supposed to receive for the year, 18,000. You remember, we calculated it over here. Therefore, it means from what we have received and what we are supposed to receive, there's an amount that is still owing. And that amount that is due to us is 12,600. You remember this one. So that is how you then record it. The amount from the trial balance plus the amount that is accrued. This is accrued income. And then you come and get what we are supposed to get for the entire financial year. That is how you do it when they tell you provide for outstanding interest. Where do you look? The interest that you have received, and then you say, how much had we invested and what was the interest rate? That is 10% per annum. Let us now look at the next adjustment. Adjustment number 4, bad debts. What are bad debts? Bad debts is when a debtor is no longer able to settle their account. So we write off the account as a bad debt. So here we are told bad debts of 1,660 must be written off the account of G. Clever. So G. Clever is a debtor, and this debtor is no longer able to settle their account. All right? So what we will do now, we will come and write this amount off. When we come here, we will now say the amount that is in the list of balances. Remember, we're in the statement of comprehensive income. This bad debt becomes an expense. It is an expense. All right? So we come in, we say our bad debts is 14,300. This is from the list of balances. And then we come and add 1,660. So we come and say plus 1,660. Then we end up with 15,960. We have added the 1,660, which is bad debts. It is very important, dear learners, that you understand that once an account is written off, it creates bad debts, and that amount is recorded under our operating expenses. Let's now go and look at adjustment number 5. Adjustment number 5 reads, commission income is received at 12% of sales. So we come to our commission income here, and then we see we have 32,000. That is the commission income. We now say the 32,000, we need to compare it. But what do we compare it with? Because we are told commission income is at 12% of sales. Again, this 32,000, is this all that we were supposed to receive? We only see that if we come to our sales. Then we say sales is 460,000. We multiply that by 12%. All right? So we want to get commission income. So we are now saying our 460,000 multiplied by 12%. I want you to punch that in your calculator, and I want you to tell me how much do we then get. So you are saying, again, 460,000 multiplied by 12%. All right? That should give you 55,200. All right? Yet here we have 32,000. That means when we come into our statement of comprehensive income, commission income goes to other operating income. All right? So we say commission income. The amount in the list of balances is 32. Yet for the year we are supposed to get 55,200. That is what we are supposed to get for this financial year. That means there is some commission income that we have not yet received. Because when we say 460,000, which is our total sales, multiplied by the 12% which we're given, it gives us 55,200, which we bring here. Therefore, the amount that we have not yet received becomes 23,200. This is how we would then do it when we prepare the statement of comprehensive income. There is an amount that we have not yet received that we were supposed to have received. Dear learners, thank you so much for joining me in today's class, and I hope to see you again very soon. It is goodbye.